all see it at the same time. And you'll get that information today at 9:10. All right. Why are you joining us? Because, again, at 9:30, you're the exit liquidity of institutions playing games before 9:30 in the pre-market hours from 7 o'clock to 9:30. We're going to talk about the stocks worth trading today. That's what the runner is about. That's what you'll get in 12 minutes. We'll talk about what's happening with momentum. Yesterday, a move down to yellow on our reading only to snap back because, well, that's what algos do. We'll also run a couple of screens and give you some inside information. But to start off, and there is your schedule for the day. Just a reminder that I am coming in on the final hour as well, which makes it quite a day, right? Start the day, end the day. Want to focus on momentum and volume at the open, and then focus on volume and the close. So we are in an S&P environment where we are weakening, but as we saw yesterday, markets do not go straight down. We have a push down. We now push up. Now we're starting to sell off again a little bit more, hopefully taking that stair-step pattern down that we see when we do witness sell-offs. And our key line in the sand for the S&P 500 will be the MAGS 7 round hill. Pay very close attention to this on the daily, everybody. Hovering here at that 20-day moving average, currently 1%. If we see further weakness, it's going to be a retest of that 50-day moving average. But as we've seen, it's all about the MAG 7 right now. The Russell 2000 continuing to chop around, but it is negative. We're holding at that 20-day moving average. But I keep saying, watch the RWM, which is the Russell inverse, and we're looking for continued weakness on this depending on what Powell says tomorrow. This is a very difficult time for the small cap space, and concerns about inflation continue to persist, as are the concerns about interest rates. And there is a significant similarity between today and what the Federal Reserve is doing and what the German bank was doing back in the 1980s that caused a lot of turmoil. Yes, we are above the 20-day moving average, and that puts us on alert in that weakening green to yellow range. We are not above the 50-day moving average, which is very important at this moment. Good morning, Secret Agent Charlie. Thanks for joining us. But we are negative on our S&P 500 reading, meaning that money is leaving largely at the bottom end of the 493 stocks that are not part 498 stocks that are not part of the Magnificent Seven. 850. What is going on with futures? Well, we're looking at this right now. Paying across the board. We're slipping, but again, 6,400. If you would have told everybody that we would be at 6,400 back on April 7th, a lot of people would have laughed at you because, again, remember that everyone was talking about the next Great Depression. And then 2 days later, we had accommodation and the largest insider buying pattern of the last 6 months. Russell continuing to show a little bit of weakness, 2,300, the line in the sand. And we have other global markets all pushing near all-time highs. The VIX, though, continues to rise, 18.5. And that was why I was saying 2 days ago that it was still very cheap at this moment to hedge. And we also put up that historical chart showing that this is historically one of the most, if not the most volatile times in the market in this last 2 weeks of August as we move into the weak period of the year, which is September seasonally. But we can't just say the past performance indicates future outcomes. We know that, but big box retailers reporting earnings, Walmart coming out today, hiking expectations, strong numbers ahead of the earnings. The odds for a rate cut has continued to decline, which is stunning. We are at 79% now on the CME Fed Watch, and the odds of a 50-point basis cut have now moved to the downside and are now no longer the favorite for the October period, which signals a possibility of, again, no cut in not just no cut in September, but you could see the odds of a no cut in October by October now rising to 10%. So the market's getting a little bit more increasingly concerned about what Powell is going to say and whether he is going to maintain that line on independence and continue to argue, as was noted yesterday in the Fed minutes, that inflation and tariffs remain a core concern, and whether or not the U.S. economy is strong enough, and it is strong enough. But once again, as we've noted, if you go back to some historical numbers and you analyze the assessment of just a few years ago of the U.S. labor force, in the U.S. unemployment rate would be somewhere around 4.9% if we were basing it on labor force participation rate from just a few years ago. Again, oh yeah, I owe a card to somebody. Let me know. Is it the Juan Soto? Somebody. Let me know. All right. Bitcoin rebounded. Yeah, I know I owe somebody a card on this. I forgot about it. I apologize. It's been a long week. Bitcoin did rebound to 114,700. A lot of focus again on Powell's speech. The U.S. is steady, hitting a near weekly high, and oil prices continuing to rise. And if we're paying very close attention to the dollar, it's all about the UUP, which again is hovering above this 50 and 20-day moving averages, 6 cents away. And as I've said, if you're looking to trade a bullish move on the dollar, it's very cheap to go out into September and buy calls on the UUP, because again, in this with this, it may only cost you about $50 to buy the $27 call for September, because of the leverage within the way that this is structured. So instead of putting up $2,750 to buy 100 shares, you can use $50 to buy the exact same number of shares with the rights to the number of shares for out in September. It may be around 55, but if you're looking for a continued breakout on the US dollar, as some are now, as you continue to see that in the lack of the rate cut, it becomes a nice little one-way asymmetric bet. We'll figure it out. Don't let him not give it. Okay. I'm on air too much. Forget what you say sometimes. All right. Again, when it comes to these markets, it's been summer. It's been a long summer. It's a lot going on, and everybody's getting ready to go back to school. I'm tired. I know a lot of you probably are, but it really comes down to the fact that when we think about the market and you see the stretch and the run that we've had going back to April, when he goes back to April, the run that we've had from 48.50 to 6,400 is historic. It's historic. And a lot of people are wondering, how do I even continue to trade this? How do I even continue to try to trade the momentum? I continue to argue and advocate that you focus on the 20-day moving averages, because it takes a lot of money to keep the equities above those moving averages. That is a sign of inflows. So are the RSI and the MFI. So that's why we continue to focus on those indices. But it does get tiring. There is AI fatigue. There is this point where people look around and they say, I'm not willing to pay 140 times earnings for this stock. It's somebody says, I'm not willing to pay 139, 138, 37. And then it starts to trickle off. And the question becomes, where does that money rotate? Well, the rotation will obviously be in play as we look into next week, and we'll be looking as money moves around. But there's all this other noise going on. Right now, you have Trump pressuring the Fed, not just Jerome Powell, but also calling for Lisa Cook to resign on threats or claims of mortgage fraud. That would allow Trump to appoint another governor to the Federal Reserve, and that would put more pressure to lower interest rates. Now, why do they want to lower interest rates? That is the one thing that I think a lot of people are not understanding. And a lot of people believe that it only has to do with the U.S. national debt. It does not only have to do with the national debt. And I'm going to walk you through exactly what that is at 9:10 after we talk about the runner. July Fed meetings coming out yesterday, nothing new. We knew that there was a dissent among various members of the Federal Reserve. Jackson Hole's speech will be tomorrow. Jerome Powell going to put on whatever color tie he's got, let us know what he thinks about the world. And then from there, we're going to continue to brace for ongoing volatility in these markets. So key things here, this is all very highly macro and valuation driven. And that is an important component of what has been warned about when it comes to the comparisons historically to challenges that we have in the broader market. Last thing just to point out, I do want to always just note that as we look at individual sectors, the OILU energy has been very difficult to trade for the last couple of weeks. It has continued to chop around, and the signals that I use on the OILU have largely traded sideways. I am now looking for some sort of directional move on oil heading into September. It's going to be very, very important that we keep an eye on this, but my expectation is oil to the downside, particularly with the focus on OPEC increasing its output next month, in addition to the fact that we're continuing to have conversations with Russia and broader weakness in the U.S. economy. Thing about this, though, is if I'm going to go short, I need to ensure that the OILU remains under these key moving averages. This would imply bullishness if we start to break above these lines, which means I'm not going to try to short names like Apache or Fang or Diamondback is Fang or Devon Energy or any of the other names that I traditionally would take aim at for weakness in the energy sector. On the other side, if you're watching the semiconductors around POW, you want to be watching the OSXL, and that has been breaking down in recent days. This is the Triple Bull ETF around semiconductor stocks, hovering at that 250-day moving average. If the SOXS, which is the inverse version of that, starts to creep up and move above these 50-day moving average, as the SOXL starts to break down, that is going to be very bearish for everything in the semiconductor space. AMD, NVIDIA are obviously at the top of the food chain, but look at the other names. Look at the Intels. Look at the other potential stocks that could sell off as a result of this continued weakness that we have seen going back to last Wednesday. Okay. Finally, before we hit the main event and get into the runner, I do just want to note that if you look at insider buying right now, insiders are not putting down their own money for stocks. And this is absolutely essential that people recognize this in this environment. There is ample amounts of uncertainty in the financial markets. And as a result of this, if we look at the insider buy to sell ratios, which is part of our daily checklist, we are nowhere. So even though we've had this little bit of a down draw, I want you to continue to watch what insiders are doing. This is the 5-day moving average of insider buying in real dollars to selling. We are weak. If we start to see strength and something get back up to around that April level, that is going to be the contrarian sign to buy. And once again, if we look at the screener, CEOs and CFOs, not a ton of purchasing at the moment. Eli Lilly, Blackstone Minerals, which we've talked about, First Citizens Bank, but the selling ratio to the buying ratio is very significant right now. And it's just a sign that executives are selling their stock because that is part of their compensation. They're not holding on to it. They're taking the money. And in this case, they're not buying, which again, that is a sign of continued concerns about the broader market. Let's get some coffee. Coffee time. A little break, a little treat. That's exciting. I have about 12 of these cups at my desk. My wife keeps asking, where's all the coffee mugs? I don't know. Go downstairs and find them. All right. This morning, looking at the runner, digging into it, putting this into the chat. It should be in the chat. Should be on. There we go. We got it. Click me, it says. That's exciting. Look at that. Little horse racing reference. Just to go back to the book that I always talk about. There's a book called Value Handicapping. This is by Mark Kramer. And what the book bases is that the majority of good handicappers will lose more than they win, but they also don't bet every single race. That's important, right? They don't bet every single race. What they're looking for are very specific conditions at any given moment. Any given moment. So they're going to try to find something that's mispriced or know that this one particular horse runs well in certain conditions. Well, that's what we're doing here. We're analyzing individual stocks in certain conditions based on basically the technicals and what else is happening in the broader economic environment. So we're constantly looking for high probability setups, and we're constantly looking to take advantage. And yesterday, we talked about SandRidge. Now, SandRidge, even though I had a negative viewpoint on this because of what happened with the energy still being weak, we had sizable amounts of insider buying. The stock has been moving higher and pushed to new highs yesterday. Big rebound yesterday. But the strength looks to be continuing in SandRidge. And today, yesterday, we were also talking about Palantir. And Palantir continues to suffer. Big move down in the first hour and then having that rebound. It goes back to this that I do want to note when it comes to these breakdown stocks, particularly the more liquid ones, I've said in the conditions that we operate in that you're constantly looking for reversions if they arrive. And yesterday, we didn't get down into the third or fourth standard deviation, but we did get down to the point where the stock hit the hour at 11 o'clock and then started to rebound. And it, again, as I've said, trading above volume weighted average price or just the blue line using Palantir or any of the leveraged ETFs and just day trading the individual stock is an option. Now, on Fridays, that's where you're going to have options expiring. But again, the key thing is they're going to have names like Palantir and Tesla relatively soon with same day options. So there's going to be a lot more of this, and there's going to be a lot more swing trading built around this as well. You get to watch the horse pre-walk, gait, sweat to determine they're ready to run. Exactly. So CLNE is at the top of the list today, and that's Clean Energy Fuels. And we see a stock that is continuing to showcase strong momentum in the oil and refinery space. Again, in this environment, just slow, strong, bullish momentum, holding above that 223 line. And this is just a stock that you buy and you hold and you keep a tight stop. And we're looking for, again, continuation to the upside on some of these names. If energy continues to do well and we see continued improvements in crack spreads and refining, then obviously bullish. Everything here checks the boxes. Stronger ADX, MACD improving. Looking at the MFI and the RSI. I'm going to add another name off of that, and that's DraftKings. Wow, look at that. DraftKings. Same thing. I'm going to hold on this one. This is a tough one for me, but just seeing it, it's one of these things where momentum doesn't lie. If you get down and you retest that 20-day moving average, that will be a point to potentially go long here. It has had relatively strong momentum. This is seasonal. A lot of focus again on what's coming up in the next couple of weeks with football season starting. Let's go to the third one, MPW, which is Medical Properties Trust. And there you go. Somebody asked about this yesterday, actually. An MPD coming off that 20-day moving average. This is an interesting stock. This was a stock that I was recommending back during COVID, and I've kind of largely walked away from it because the medical industry, the hospital industry is under a lot of stress. But if interest rates do come down, and there are hints toward that, then there is upside and strength to some of these REITs. On the weak side, Carvana, and it's always sad to have to go against Carvana. Look at Carvana, poor Carvana. But the stock was at 6 at the height of the gilt crisis, and it has gone all the way up to 400. And it is a reminder that these markets are amazing and insane, but these stocks will break down, holding at that 50-day moving average. If we break under the 50, and that's what we're looking for, and stay there, 1.3%, relatively simple trade. You buy at the money, you sell out of the money, and you use the spread to provide you some protection to the upside, just in case the stock continues to rebound. But again, looking for weakness in the consumer cyclical space. I don't have the option chain in front of me, but the way that I would look at this is, effectively maybe the 340 and sell the 335 going out to September. Just a high probability trade. Let's take a look at that. Put spread. Carvana, CRVA. CarVNA. There we go. Look at that. I'm so good with technology. All right, just to give you an example of what the math would look like this. Pretty wide spreads. I don't like that, but it is what it is. That ain't terrible. You're going to have to limit order something like this. But 335. Wow. buying the 335 and writing the 330 would be a $200 trade, 48% probability of profit. It's actually a pretty good setup, to be very candid, because again, Carvana at its key moving average, right, which is here, 446, 441, you know that if you push back above that 20-day moving average, you lose 6%. That's it. But if you start to really break down in the stock and it continues to move lower, you've got your percentage points lined up. So interesting little idea there. September 19th, 335 to 330. The odds will be a little bit higher, but you're putting up 198 to make 302 with a 48.4% probability of profit. Tight stop at the 20-day moving average. On top of that, to the downside, looking at CCJ, Cameco, yep. More weakness on that 50-day moving average. That is something that could have been and should have been caught back here at the 20 with that rollover here on the MACD and the rollover here on the MFI. 1, 2, 3, 4. That was the spot. But if you're going to try to continue with momentum, staying here at the maybe 72.50 if that exists, and selling down to the 67.50 or something in that range. And then Broadcom, we just talked about the fact that we're watching the semis, and this is a tough one, but again, 290 down to 280 is kind of what you're looking for here. Retest of that 50-day moving average. We saw that happen, little tick that happened 2 days ago on the where was this? Happened yesterday. Looking for continued weakness here. 290 down to 280, something in that range. WDC on momentum. So now you have this other stock, right, that is holding its line on the 20-day moving average. This is going to be a line in the sand stock. And if this breaks under that 20, I'm going to be shorting it. And how to do that? Again, if we can get under that level, it's 74 down to about 68 or 74 down to 70. Short duration, maybe 2 weeks, maybe 3 weeks, and then simply, again, using this as a line in the sand just in case it breaks back above that moving average. SanDisk continues to move as well, SNDK. So SanDisk, as we watch, continuing to chop around. The way that this stock is moving and the way that it's kind of trading sideways, it reminds me a little bit of, what is that called? Yeah, that is called a freeze point. That's what that reminds me of. I don't know if that's exactly right, but this is a stock that's trading sideways and we're looking for a breakout. And it's a reminder that you should be clicking the link that is above from the presentation from Gianni yesterday, talking about stocks that get stuck in these zones and then suddenly make these very powerful moves. The link is in the chat. Watch list CRGY. So a little question about this. This is a tough one too, because this is private equity matched with the same thing. Sideways trading, but private equity matched with upstream oil and gas. This stock's underperformed my expectations in recent years. It's been a long time darling because this is a company that in the event that these companies would have gone out of business, these smaller oil producers, they would have gobbled them up for pennies on the dollar. The big problem, unfortunately, for Crescent is that interest rates have not been the driver of the economy in the last couple of years. Cheap liquidity has been. So resultantly, we're trading sideways right now. The OIOU is currently holding at that 50 and 20 as well. Follow the OIOU. That will take you directionally on which way to speculate on CRGY. But it is a value name. It is definitely something to be paying attention to if the OIOU breaks above that 20-day moving average. And a stock that we talked about time and time again is Calm. Cal-Maine just continues to be just pure strong momentum after that huge sell-off that we saw. Again, it's one of the funniest stocks that I've ever had a conversation about because it was back on the value and momentum screener that we had back 4 or 5 years ago. And somebody said, I'm not paying $20 for eggs. And it's been literally like one of the best stocks of the last couple of years because of avian flu and because of inflation and everything that comes with it. And once again, all roads point to more monetary inflation. I am bullish on the eggs. Finally, one last thing. Pay very close attention to the property and casualty world. Donegal Group bouncing around. Not necessarily something that I want to trade But these are rate cut sensitive stocks, and property and casualty stocks need to be in focus as well. Companies like Kinsale Group as well. This is one of the best pure player stocks that are out there. Very comparable to a Berkshire Hathaway over the long term. That's something that I personally own, but look for property and casualty names to continue to be strong stocks in the future. So far as sectors go, we continue in the healthcare side, LABU. Again, in focus on the daily chart, pushing above that 20 and that 50. That's good for biotech names. Staples and real estate looking good. Technology, communications, and discretionary are under pressure. There does seem to be a rotation to some risk-off categories at the moment, but be very, very cautious in this environment. The next 24 hours are going to set the tone for the next 3 to 4 weeks. All right, UK Ray is curious what soccer team you support. Oh, you're not going to like this answer. In 1994, I got to see in 1990 I saw my first NHL hockey game, and I became a fan of virtually every sport that I am a Buffalo Bills fan because we didn't have a team growing up. So I latched on to Jim Kelly in the 4 losing Super Bowls. I am a diehard Orioles fan, but I lived in Chicago for years and had been a Chicago Cubs season ticket holder for years and years and was there during the World Series. So those are my three places. Okay, where do I waste the rest of my time? First hockey game I ever went to was in 1991. It was in Madison Square Garden, and I became a New York Rangers fan that day. And then in 1994, there was a soccer game that was played on television in the United States, in England, and I'd never seen it before. And there were 2 teams, and one jersey was red. I don't like red. And one jersey was blue, and that blue jersey was Chelsea. And I have not stopped rooting for that freaking team since. And it legitimately, I go every year, I'm like, who's on the team? Don't know any of those guys. Probably not going to watch. So there's video of me celebrating when they won the Champions League. Terry off the post was one of the worst days ever. It's Chelsea. I'm sorry. It's not changing. You can't change horses 27 years later. It just doesn't work like that, okay? So I'm not going to get into Everton. I'm not going to start rooting for Wrexham because it's trendy. I'll give Brett Man City. That's fine. That doesn't bother me. Man U drives me nuts, and I don't like Liverpool. So also not a rant. All right. Last thing. I want to point this out. I want to be very honest with you. I don't care what Pal says tomorrow. I really don't. Because I only care what he actually does. And I'm going to finish this with a very simple 5 minutes to explain to you what the hell is going on in the financial system. Michael Howell talked about this morning, but I've been writing about this for the last 3.5 months. The ghosts of 1987 are here. This is not, hey, you might not even remember 1987, but you have to understand the underlying plumbing of 1987. The key thing was we had the Plaza Accord back in 85. That set the tone for 1987. Today we have the Mar-a-Lago Accord. That's setting the tone for something relatively significant in the next 2 to 3 years. Now, Hal sees it. Albert Edwards at SocGen sees it. Paul Tudor Jones sees it. Even the Fed has admitted that the hedge funds nearly broke the entire financial system last August. Remember, I have been saying over and over again, for some apparent reason, we don't talk about this. That move right there. That was the Nikkei crash last year. Nobody talks about it. That's because the hedge funds nearly sank the entire financial system. And right here, this move right here, the hedge funds nearly sank the entire financial system. Oh, and back here, the hedge funds nearly sank the entire financial system. Do I need to keep doing this? Every single major downturn has been a major liquidity event over the last 5 to 6 years. And in fact, you go back to 1987, same thing. Hal laid out this morning that the parallels between Jackson Hole and here are very significant. The liquidity momentum that we've had is running on fumes. In 87, it was Germany's bank that did not want to cut rates. Now it's the Fed. And Albert Edwards has said at SocGen, this is the guy who called the dot-com bubble, said that we could get some sort of 87-like event simply because of high valuations and declining liquidity. Yeah, that's it. That's the recipe. The concerns are, again, what we have to watch, and we always have to watch, the damn bond market. Watch the bond market. Don't look at anything else. Pay very close attention to wherever the bonds are. There we go. Pay very close attention to the 2-year and the 10-year, because what is happening is that there's going to be a drain on capital in the system, and it's coming soon, and I'm going to explain why. Back in April, Janet Yellen was being interviewed in Australia doing her world tour, and she said we had leveraged hedge funds that were unwinding, and that was the reason why there was this sell-off, right? And it happens in multiple patterns. It's the same pattern over and over again. I feel like I'm taking crazy pills. But again, as we've seen, nobody asked, why did the hedge funds have these things in the first place? It's because we tolerate it. There's $1 trillion to $2 trillion in what's called the basis trade. And that sucks up a lot of the bonds and helps suppress yields. The thing about now in the 80s, as Henry Maxey at Ruffer said, is that you've got algos, pro-cyclical margin requirements, and multi-strategy hedge funds that are all programmed to sell at the exact same time. And that's what leads to this. So why does this matter? Well, it's synchronized swimming, but basically everybody drowns at the same time. And Mark Spitznagel at Universal, who's basically Nassim Taleb's protege in Black Swan investing, has said when the Fed finally does cut rates, it means the recession's here, and that will create chaos as well. At the end of the day, this comes back to the basis trade. It comes back to the fact that we have all of this leverage in the system, and now we have a lot of math that's going to get really, really tricky right now. In the next couple of months, I want you to keep a very close eye on what we've talked about, the Chicago National Economic Conditions Index. This right here is one of the most staggering charts that you will see, because for the last 2 years, we've been told that the Federal Reserve is tightening. They're not. This is not a tightening environment. In fact, this is as loose as far as economic conditions go as any point post-COVID. In addition to that, our financial conditions spot index is the loosest it's been since COVID. So what does this mean? Well, we've been told that the Fed has been cutting its balance sheet by $250 billion this year. They actually increased it by $350 billion through accounting. They drained the Treasury General account, they stripped the reverse repo, and they basically also added tariff wars. All of these people basically are saying that the exact same things have to come. We may have an event in September or October. It could come in December. But to address the fact that we have a huge drain coming, and what this means is the Treasury Department's going to have to restore its cash balance sheet this year to $850 billion. They're going to have to pull $500 billion from the financial markets. Well, what is this going to lead to? Very similar situations, potentially, to what we saw with England. They are going to need to do the following things: cut interest rates quickly, let inflation run, end quantitative tightening, let the Treasury keep its balance sheet depleted, fund everything with T-bills, force banks and stablecoin operators to buy all that debt, and prevent bond volatility to keep the leveraged hedge funds from blowing up like long-term capital management or Lehman. Yeah, that's where we are. Edwards, Tudor Jones, Spitznagel, Howe. There's going to be a lot of volatility in the next couple of months. And the great thing about that as traders is we know how to trade it both ways. So if you are fearing the market, if you're fearing a downturn, if you're seeing things around crashes or anything else, first off, this is what I do. I love this stuff because I see it from 100 miles away. Don trades volatility unlike anyone else in the market, and we have a team of experts who are constantly watching money flow every single day. So as I say, if you're not a member and you're not watching us during the day, you're leaving money on the table. We will walk you through these conditions. And again, I'll be here every step of the way to walk you through momentum every single day. Something significant is going to occur, and we're going to see something transformational likely in the next 2 days, where they're going to basically say nothing, but they're going to have to start to turn the money printer back on. And it's not going to make sense to people. We may go down, but then suddenly we find ourselves right back up at 7,000 a lot faster than you can imagine. It's going to be a wild couple of months. Glad that you're all here. I hope you guys have a great day. Don's coming up right now. Talk to you in a bit.